What's going on, guys? In this video, we're going to be talking about the infamous Fed pivot and what you should do when that day comes. You can see right here, this is the federal funds rate that you could actually look at on TradingView, which is pretty cool. Just type in Fed funds and it'll show you the effective federal funds rate. Right now, we are sitting at 2.56. By the end of the year, they want to be at, I think, like 3.5 or 4%. And in November, we will most likely get another 75 basis point hike. That's at least what everyone's predicting. Some people are even predicting a 100 basis point hike. The market has been going down year to date. We have been in a bear market. Call it whatever you want, but 2 quarters of negative GDP is defined as a bear market, and that's exactly what we had. The market is down more than 20% from all-time highs, and everyone's wondering, what's going to happen when the Fed finally pivots? Is that going to be the buying opportunity? And let me tell you, I don't think it is. This meme sums it up. Investors are chasing this Fed pivot, but when that pivot actually happens, don't expect the market to bounce. Sure, it can. What do I know? No one could time the market. No one knows what's going to happen in the future. But if we look in the past, that is not what happened each time the Fed pivot. This is what I mean. You're looking at the S&P 500 and the US federal funds rate on one chart. And you can see right here, here's the rate going up. But let's look in the past. So first, I want to look at back during the housing market crash. The red bars, this chart's awful. The red bars is pretty much showing the federal rate. And you can see when they pivoted. They pivoted right about here. And as they continued to cut rates for pretty much 2 years, the market continued to go down. They pretty much bottomed out at almost zero on December 1st, 2008, and the market continued to go down until March 4th, 2009. So even though they cut rates down to zero, the market was still rolling over and didn't bottom out finally until 2009. And then it bounced. If we zoom out and let's take a look at how about the dot-com bubble, something very similar. You could see the market was going up and rates were pretty much between, say, call it 4 and 6%. They started to cut rates. The market started to go down. They started to cut rates, and the market continued to go down until about 2002-ish, 2002, 2003, and then it started to bounce again. So just because the Fed will pivot, because that will happen, the Fed's going to have to pivot eventually. And when that happens, everyone's expecting the market to soar back. That's not going to be the case. Most likely that's not going to be the case because that didn't happen in 2008. That didn't happen in 2000. And then we could probably look at a couple of other examples, but this isn't the best chart to do that. But that's not the point. The point of this video is to tell you what you should do. So if I'm telling you the Fed will not, if I'm telling you when the Fed pivots, the market will not bounce, well, then what do? Do you just sit on the sideline waiting for this bottom? How can you time the bottom? I'm not here to tell you where the bottom is. And if anyone tells you where the bottom is, they're lying. No one knows where the bottom is. No one knew that the market was going to have a V-shaped recovery. You have people guessing, and some people are going to get lucky and get it right. But no one truly knew that it would be a V-shaped recovery. And then from the bottom of COVID, it would go up 124%. No one would have guessed that. You zoom in, everyone was rallying from June to August because they thought the Fed was going to pivot there, and the Fed just got even more aggressive, and now we hit new lows. So what can you do? This is what you could do. It's the simple answer that you're not going to like to hear, but you know it's true, and that's just continue to dollar cost average. But hold on, don't log off because I know plenty of people have already told you that. I'm actually going to show you the numbers. So fine, you're going to be a good little investor and dollar cost average throughout this bear market. Well, what is that actually going to look like? We're going to jump over to this really neat calculator I've used before. I'll leave a link in the description, but it's the S&P 500 Periodic Reinvestment Calculator with dividends. So we're going to take a look in the past. We're going to go back, say, August of 2000. That was the dot-com bubble. That was at the peak. So if we scroll back, here we go. So you can see right here, August of 2000 was the peak of the dot-com bubble. Or this is September. So September and August. And then we had a bear market for the next 3 years. It recovered. We were in the green for a little bit, and then we had the housing market crash. And then finally, it recovered pretty much 12 years later. So you've been in the red majority of the time for 12 years straight. So what would that look like if you invested, say, $100? And let's say you didn't put any more in. You just put $100, sorry, not 100, $10,000 in August of 2000, and then you held it for those 12 years. We're going to hit calculate. And you can see you just barely broke even after 12 years. If we go back how about a couple of years, 10 years, you'd be in the negative. You would have lost more than $1,000 if you held on to it for 10 years and didn't invest anything else. And we could even show the graph. This is what it would look like. You had $10,000, and then a couple years later, it turned into $5,000. You held on to it up until the housing market crash. You're at 11,000. You're feeling good. You think things are going to finally turn around. And then boom, you're right back down to $5,000 a couple years later. And you still hold on to it. And you still haven't recovered after a decade your initial investment. And that's going to scare a lot of investors away. But that's why the key is dollar cost averaging. This is what happens. Let's say that you just invest $100 more each month. That's very simple. That's $1,200 a year. We hit calculate. It looks a lot different now. You could see that you started with that $10,000 investment. Your investment is going down, but you're continuing to contribute. So now you're buying at these lows, and then it goes up. And yes, you're buying at the highs, but you're not here to time the market, because when it rolls over again, now you're buying at the lows again, and then it's continuing to go up. And I get that this isn't the best example because you're still technically in the negative overall. You would have invested $22,000 and you're only left with $2,100. $22,000, you're left with $21,000. So you lost almost $1,000 here. But that's only if you were doing $100 a month and you already had a big initial investment of $10,000, relatively speaking. Let's do something a little bit more realistic. How about $500 a month? Where did I get that? Well, you can invest $6,000 into an IRA, which is $500 a month. 500 times 12 is 6,000. So let's say you're just contributing into an IRA for this entire decade. Let's hit recalculate. Now you can see things are looking a little bit different. You're actually positive for once. You put in 70,000 and now it's at 73,000. So, okay, feeling a little bit better. You actually made some money, even though it's very minuscule. And yeah, I know, account for inflation and you actually didn't make any money. But again, that was one of the worst decades that we've had in recent history. Let's zoom out. What happens after 20 something years? It's a much different picture. You're now up over 8%. You've beat inflation over the past 20 years. And that $142,000 that you invested turned into $420,000. You've made $389,000, almost $400,000 by just blindly putting it into the market, dollar cost averaging from the highs and the lows. That is what you have to do. It is a long-term game. Don't expect you to become rich overnight, and the market could continue to go down for the next year or two, and you'll continue to lose money, but you are continuing to dollar cost average and buying at these lows because eventually the market will turn over and we will be into a new bull market and you'll finally be making a positive return on that investment. But that's pretty much what I got for you guys. Again, a link in the description so you can check out this website. It's a pretty cool calculator. It's not financial advice. This is my thoughts, my opinions, my strategy, and it's what a lot of other people would also tell you to do. So if you like this video, make sure to smash that like button. And guys, as always, I will see you in the next one.